Last month, the US CB consumer sentiment fell for a fifth straight month. CB data showed that expectations index fell to its lowest level since October 2011. This index is based on short-term outlook for income, business, and labor market conditions. Notably, the share of consumers expecting fewer jobs in the next 6 months was nearly as high as in April 2009. This doesn't bode well for the real estate market in the US. With me, Fiona Cincotta at StoneX's head of MBS trading, Matthew Johannes. Thank you for joining us, Matthew.
Thank you for having me.
So the housing market has slowed dramatically, and high mortgage rates are not the only reason. Clearly, recent data showed that concerns about the economy are now spreading to the consumer. Can you give us your take on the most recent data?
Yeah, so I think obviously in general, I will say it's going to take more time than just a couple weeks to absorb some of the data changes, right? I think the market in general is having to get used to a White House that operates in real time with direct feedback to the consumer and the markets and basically by the minute versus other administrations that maybe have been slower to kind of explain what's going on with whether negotiations of tariffs, et cetera. So the market's learning how to adjust to that, and there's so much uncertainty and volatility that the data points, you're not going to really see them come through and see what the actual effects are, in my opinion, until Q3 or Q4 of this year, right? It's going to take time. So you move into a market where you have eroding consumer confidence, driven around the uncertainty around tariffs, but then you walk into this week where that was from an April 29th reading, and this week you have some good things coming out of the administration now with potentially China and the U.S. Pausing tariffs for 90 days and kind of renegotiating around there. So the market feels differently and risk reacts very differently. So in general, I think the data is going to take time to work through at this point. And you're going to get blips and it's going to be kind of scary at points, but it's not necessarily the full picture yet.
And do you reckon that we could say that a technical recession is around the corner?
Yeah, so you could see a technical recession, right? One more negative GDP print would technically put us into a technical recession. But in general, I think there is some noise around that as the whole market is having to digest and kind of realize the uncertainty of those numbers, right? So you may have a slower growth period, but that's not necessarily foreshadowing the whole health of the economy. I think the more concerning points that we have now is you have PPI moving lower, CPI moving lower, which naturally is a trend for lower inflation, which should start the conversation around potentially rate cuts. But the market currently is completely reacting completely different at this point, right? You see the 10-year note moving close to 450, long end treasuries are near 5% at this point, and long-term inflation readings from University of Michigan's long-term CPI and inflation readings, they're basically saying they're at all-time highs since 1995, I think it is. So the market's fearing inflation. The Fed doesn't want to do anything. And now you're in a scenario where you have higher rates, and that could ultimately be more impactful, I think, long-term than what we're seeing kind of in the near term and maybe a negative technical recession. That's going to need to be worked through at this point.
So shall we fear even worse? Could we expect another systemic crash of the US real estate market?
So I think, when people talk about the US housing market and comparing it to 2007 and 2008, it's a very different market, right? What we had in 2007, 2008 was a very different product mix that we have currently. If you look at the US mortgage bonds, so Fannie, Freddie, and Ginnie debt, and you take the weighted average coupon of the entire universe, the coupon I think is like 4.07 for Fannie, 4.17 for Freddie, and maybe a little bit higher for Ginnie. So the actual rate that most of our borrowers and have at this point are very low. They're very manageable at this point, and there is not a lot of floating rate debt or that will remark to market at any point. So what you might have more is an area where housing slows because there's no turnover, right? No one wants to leave their house. No one wants to buy something new because they'd have to take a 6.5 or 6.9% mortgage rate. So it's not necessarily you have a negative as in the housing market. It's probably more pocketed to areas that saw a lot of inflows during COVID, right? You look at Florida, Texas, some of the Californias, those saw large population growth periods during COVID. Now we're in this period where that housing market may have been propped up a lot, so it has a far way to fall. But then look at the upper Northeast. Housing prices are actually increasing, and there's actually no supply up here. So that's creating a very different housing. You can't make a sweeping statement about the housing market now, I think, across the full US. There's very different portions of it. And we're going to kind of see how that works through going forward. But in general, I think it's case by case in a lot of ways. Right.
Excellent. Well, thank you very much for your analysis once again, Matthew. Great to have you on here.
No problem. Thank you for having me.
For more videos like this, please do like and subscribe.